Institutional Equity Research Report, NASDAQ, CEG, Constellation Energy Corporation. The world's largest private power producer turns its nuclear fleet into an AI power contract. Machine. Executive Summary. Constellation Energy Corporation is a Baltimore-headquartered power generation company that became an independent, publicly traded entity on February 1, 2022, when it was spun off from Exelon Corporation. The company describes itself as the world's largest private sector power producer and the nation's largest producer of carbon-free energy, anchored by the largest nuclear fleet in the United States, 22 gigawatts of capacity across 25 reactor units at 14 plants, including a stake in Texas's South Texas project. In plain terms, Constellation owns and operates power plants, overwhelmingly nuclear, plus a growing natural gas and renewables portfolio, and sells that electricity into competitive wholesale markets and directly to large commercial and industrial customers, rather than operating as a traditional, rate-regulated utility. That business model has put Constellation at the center of one of the most important commercial stories in American energy, as AI data centers drive an unprecedented surge in electricity demand. Hyperscalers like Microsoft and Meta have turned directly to Constellation for long-term carbon-free nuclear power contracts, most famously the 20-year agreement to restart 3 Mile Island Unit 1, now renamed the Crane Clean Energy Center, exclusively for Microsoft. The company's scale increased dramatically on January 7, 2026, when it completed its roughly $21.8 billion acquisition of Calpine Corporation, adding substantial natural gas and geothermal generation capacity in pushing Constellation's combined fleet toward approximately 60 gigawatts. Q2 2026 results, reported August 5, 2026, showed this larger platform translating directly into earnings. Revenue grew 23% year-over-year to $7.50 billion. Adjusted operating EPS of $2.55 beat consensus by 8.05%. And management raised full-year 2026 EPS guidance to $11.50 to $12.50, up from $11 to $12. Flagship AI power deal, 20-year Microsoft PPA to restart 3 Mile Island Unit 1, now renamed the Crane Clean Energy Center, on track for H2 2027 return. Section 02. Investment Thesis. The bull case for Constellation is that it owns the single most valuable asset class in American power generation at precisely the moment the market wants it most: large-scale, reliable, carbon-free nuclear capacity, at a time when AI data centers are driving the fastest electricity demand growth in decades, and hyperscalers are willing to sign 20-year contracts to secure it. The Calpine acquisition adds meaningful natural gas and geothermal scale and diversification. The Crane Clean Energy Center restart remains on schedule and has cleared key NRC and FERC regulatory milestones, and management continues signing new long-term nuclear power purchase agreements, 920 megawatts of new deals in Q2 2026 alone, while simultaneously returning capital to shareholders through substantial share buybacks, $2.2 billion deployed year to date. The bear case centers on integration execution and valuation dynamics following a transformational debt-funded acquisition. Constellation took on $12.6 billion of assumed Calpine debt and issued 50 million new shares to fund the deal, and still must complete court-mandated divestitures, 5 PJM gas plants to IS Power, plus the Brazos Valley Energy Center by year-end 2026 to satisfy antitrust requirements. Despite the strong quarter and raised guidance, CEG shares are down roughly 21% over the trailing year, which independent analysis attributes partly to post-acquisition lockup expiries and a handful of analyst downgrades, a reminder that even a company with genuinely excellent underlying assets can see its stock pressured by deal-related technical factors and shifting sentiment around the broader AI power trade. Thesis in one sentence: Constellation Energy has positioned itself as the primary power counterparty for America's AI data center buildout, backed by the nation's largest nuclear fleet and a newly expanded, more diversified power platform following the Calpine acquisition. But investors need to watch how cleanly that large debt-funded deal integrates and whether the stock's recent underperformance reflects durable concerns or simply post-deal technical pressure. Section 3. Company Overview. Legal Entity. Constellation Energy Corporation. Headquarters, Baltimore, Maryland. Exchange, ticker, NASDAQ, CEG. NASDAQ 100 component. Corporate origins. Traces to the 1999 formation of Constellation Energy Group, Inc., became today's independent entity via spin-off from Exelon Corporation, Feb. 1, 2022. President and CEO, Joseph Dominguez, since spin-off, previously CEO of Exelon Generation. CFO, Shane Smith, Executive President and Chief Financial Officer. Employees, approximately 16,000. Combined fleet post-Calpine, approximately 60 gigawatts, including 22 gigawatts/25 units/14 plants of nuclear capacity, the largest nuclear fleet in the United States. Corporate milestones. Date: milestone, Feb. 1, 2022. Constellation Energy becomes an independent publicly traded company via spin-off from Exelon Corporation. September 2024. Microsoft signs a 20-year power purchase agreement for Constellation to restart 3 Mile Island Unit 1, subsequently renamed the Crane Clean Energy Center. June 2025. Constellation and Meta sign a 20-year agreement for clean nuclear energy in Illinois. July 2025. FERC approves the Calpine acquisition. DOJ requires generation asset divestitures in PJM and ECOT as a condition of approval. January 7, 2026. Constellation completes its acquisition of Calpine Corporation for total consideration of $21.8 billion, including 50 million shares and $4.3 billion cash, assuming $12.6 billion of Calpine debt. March 2026. Constellation agrees to sell 5 PJM gas plants to LS Power, approximately 4.4 gigawatts, as part of the DOJ-mandated Calpine divestiture. August 5 through 6, 2026, reports Q2 2026 results. Revenue up 23% year-over-year. Adjusted EPS beats consensus, full-year guidance raised for the second consecutive quarter. Section 4. Business Model. Constellation operates a dual-pronged business model, combining large-scale power generation with a sophisticated retail energy supply and risk management arm. On the generation side, the company owns and operates its nuclear, natural gas, hydroelectric, wind, and solar fleet as a competitive, unregulated, merchant generator, distinct from a traditional rate-regulated utility, which earns a fixed return set by regulators. Instead, Constellation captures the market price of electricity it sells, supplemented increasingly by long-term, fixed-price power purchase agreements directly with large commercial and industrial customers, particularly AI data center operators. On the customer-facing side, Constellation's retail and marketing business supplies electricity, natural gas, and related risk management products to businesses, governments, and other large energy users, generating revenue that is somewhat less exposed to wholesale price volatility than pure generation sales. Independent industry analysis has characterized Constellation's growth approach as capital light, emphasizing the use of already existing generation assets in long-term contracts, such as the Crane Clean Energy Center restart, rather than speculative new power plant construction to capture the current surge in electricity demand. How to think about it? Think of Constellation as running two complementary businesses: a massive power plant fleet that generates electricity and sells it at market prices or through long-term contracts, and a retail energy business that manages the relationship with large customers. And the current AI data center boom is allowing the company to convert its existing nuclear assets into 20-year high-value contracts without needing to build a single new power plant. Section 5. Products and Services. Product/service. Description: nuclear generation. 22 gigawatts across 25 units at 14 plants, the largest nuclear fleet in the U.S., providing reliable, carbon-free baseload power, includes the flagship Crane Clean Energy Center restart project. Natural gas and geothermal generation, Calpine. Substantial natural gas fleet plus geothermal assets added via the January 2026 Calpine acquisition, expanding Constellation's presence in Texas, ERCOT, and California. Long-term nuclear power purchase agreements. 20-year contracts with hyperscale AI data center operators, including Microsoft, Crane Clean Energy Center, and Meta, Illinois Nuclear. 920 megawatts of additional new agreements signed in Q2 2026 alone. Retail energy supply and risk management. Electricity, natural gas, and related products and risk management services for businesses, governments, and other large energy customers. Carbon-free and renewable energy certificates. Customer-centric energy solutions supporting corporate sustainability and clean energy procurement goals. The Crane restart remains the most closely watched individual project in Constellation's portfolio. The restart has cleared two significant recent regulatory milestones, with the NRC approving a new fuel licensing amendment and FERC granting a waiver to transfer capacity injection rights from the retiring Edstone facility. The plant remains on track for a second-half 2027 return to service, which would restore 835 megawatts of carbon-free capacity dedicated entirely to Microsoft under the company's 20-year agreement. How to think about it? The Crane restart is genuinely unprecedented. No U.S. nuclear plant has previously been brought back into service after a full decommissioning track shutdown, making it both Constellation's highest-profile growth catalyst and a real execution test that the broader market and potential future restart candidates industry-wide will be watching closely. Section 06. Industry Overview. The U.S. power generation industry is experiencing its most significant demand inflection in decades, driven overwhelmingly by AI data center build-out, broader digitalization, and electrification trends. This demand surge has fundamentally shifted the negotiating dynamic between power generators and their largest customers, utilities. Rather than utilities simply serving load growth through traditional rate-regulated infrastructure investment, hyperscale technology companies are now competing directly for access to existing, reliable, carbon-free generation capacity through long-term bilateral contracts, a dynamic Constellation has been particularly well-positioned to capture, given its nuclear scale. Within regional power markets specifically, PJM interconnections rules governing large load interconnection and data center co-location with power plants represent an important, still evolving regulatory frontier. PJM is expected to file its response around November 2026, with rule clarity anticipated by the first half of 2027. How these rules are ultimately structured will meaningfully affect how quickly and efficiently large data center loads can be connected directly to generation assets like Constellation's nuclear fleet.
Section 7. Market Opportunity. Constellation's most immediate opportunity is continuing to convert its existing nuclear and, increasingly, natural gas fleet into additional long-term power purchase agreements with AI data center operators and other large energy users, following the pattern established by the Microsoft and Meta deals. Management signed an additional 920 megawatts of long-term nuclear PPAs in Q2 2026 alone, and the company has cited $13.6 billion of deployable capital over the next 2 years to fund additional growth investments, share buybacks, and continued Calpine integration. Beyond new contracts, Constellation's opportunity includes successfully completing the Crane Clean Energy Center restart on its second half 2027 timeline, pursuing subsequent license renewals for additional nuclear units, having recently filed renewal applications for the Jinnah and 9 Mile Point 1 plants in New York to extend the operating life of its existing fleet, and fully realizing the commercial and cost synergies from integrating Calpine's natural gas and geothermal assets, particularly in the fast-growing Texas and California markets. How to think about the opportunity. Watch the pace of new PPA announcements as the clearest real-time signal of how the AI power opportunity is progressing for Constellation. Each new long-term contract effectively locks in more of the company's existing generation capacity at premium contracted prices, converting merchant market exposure into more predictable, multi-decade revenue streams.
Section 8. Competitive Landscape. Competitor. Listing. Positioning. NextEra Energy, NYSE, NEE, combines a regulated Florida utility with a large renewables development business, a fundamentally different, more regulated business model than Constellation's merchant generation approach. Duke Energy, NYSE, DUK, primarily a regulated utility holding company, competes for AI/data center-driven demand growth largely through rate-based infrastructure investment rather than merchant PPAs. Southern Company, NYSE, SO, another large regulated utility holding company with a growing nuclear and gas fleet, similarly reliant on the traditional regulated return model. Vistra Corp, NYSE, VST, a direct competitor within the AI power investment theme specifically, combining gas and nuclear generation with a merchant business model similar in structure to Constellation's. Talon Energy, NASDAQ, TALN, nuclear-adjacent AI power play via its Susquehanna nuclear plant's data center co-location with Amazon Web Services, though at meaningfully smaller scale than Constellation's fleet. NG Energy, NYSE, NRG, another merchant generation and retail energy competitor increasingly positioning around data center and large load demand growth. Where Constellation stands. Constellation is the dominant pure-play generation company among its peer set, distinguished by its unregulated merchant fleet structure and, above all, its unmatched nuclear scale, 22 gigawatts across 25 units, more than double the nuclear capacity of most other publicly traded competitors. This scale, combined with the credibility established through the landmark Microsoft and Meta agreements, has positioned Constellation as what independent analysis describes as the primary power counterparty for hyperscaler AI infrastructure, effectively a one-stop shop for large technology companies seeking to secure substantial, reliable, carbon-free power under long-term contract.
Management Team. Joseph Dominguez, President and Chief Executive Officer,
has led Constellation since its February 1, 2022 spin-off from Exelon, having previously served as CEO of Exelon Generation starting in 2021, overseeing its nuclear and clean energy assets across deregulated markets. A mechanical engineer by undergraduate training, New Jersey Institute of Technology, with a law degree from Rutgers, Dominguez previously served as Exelon's Chief Strategy Officer and General Counsel. He is widely credited with architecting both the Calpine acquisition and the Microsoft/Crane Clean Energy Center restart deal, and has positioned Constellation as a strategic partner to Washington and a policy leader in Washington, and a strategic partner to Silicon Valley. On the Q2 2026 earnings call, Dominguez stated, "Strong results, an increase in guidance, positive regulatory developments, good progress on strategic transactions. Our team delivered." Shane Smith, Executive Vice President and Chief Financial Officer. On the Q2 2026 earnings call, Smith stated, "Our second quarter results and increased full-year EPS guidance demonstrate the earnings power of our expanded platform, strong operational and commercial performance, and the disciplined execution of our capital allocation strategy. We remain focused on integrating Calpine, capturing the value of our expanded fleet, and investing in opportunities that generate attractive returns." Section 10. Financial Performance. Metric. H1 2025, H1 2026. Operating revenues, $12,889 million, $18,626 million, plus 44.5%. Net income attributable to common shareholders, $957 million. $2,103 million, plus 119.7%. In plain terms, Constellation's first half 2026 results more than doubled net income year over year, driven overwhelmingly by the scale added through the Calpine acquisition, which closed January 7, 2026, and has been consolidated into results since. This isn't organic growth in the traditional sense. It reflects a genuinely transformed, larger company, but the underlying operating and commercial performance, including new PPA signings and regulatory progress on Crane, has also contributed meaningfully to the improved results. Balance sheet following Calpine. Metric. Value June 30, 2026. Total assets $98,253 million. Long-term debt $19,111 million. Shareholders' equity, $31,977 million. Goodwill added from Calpine acquisition, $11,107 million. Future revenue from remaining performance obligations, $11,855 million. The Calpine acquisition materially reshaped Constellation's balance sheet. Total consideration was $21,835 million, comprising 50 million newly issued shares valued at $17,603 million and $4,342 million in cash, alongside the assumption of $12,551 million of existing Calpine debt. To satisfy Department of Justice antitrust requirements, Constellation agreed to divest 6 Calpine generation assets, 5 PJM plants sold to IS Power for $5,000 million, and the Brazos Valley Energy Center for $860 million, with both transactions expected to close by year-end 2026. Section 11. Detailed Analysis, Latest Quarterly Earnings, Q2 2026. Revenue. Operating revenues were $7,504 million, $7.50 billion, up 23% year-over-year from approximately $6.1 billion. This topped the Zacks consensus estimate by 0.48%, though it came in modestly below a separate $2.70 billion estimate cited by 24/7 Wall Street, illustrating some dispersion across different consensus sources for this quarter. Gross margin. Standalone consolidated gross margin figures, information not publicly available as a distinct reconciled line item in the specific sources reviewed for this report. Readers should consult the complete Form 10-Q on SEC EDGAR for full margin detail by segment. Operating income. Detailed standalone GAAP operating income for Q2 2026, specifically, information not publicly available as a distinct reconciled line item in the sources reviewed for this report, beyond the net income and EPS figures cited below. Readers should consult the complete 10-Q for full operating income detail. Net income. Net income attributable to common shareholders was $513 million for the quarter. GAAP earnings were $1.42 per share, while adjusted operating earnings, management's preferred non-GAAP measure that excludes certain one-time and mark-to-market items, were $2.55 per share, up 64 cents from $1.91 a year earlier. EPS. Adjusted operating EPS of $2.55 beat the $2.36 Zacks consensus estimate by 8.05%, continuing a pattern of outperformance. Constellation has beaten consensus EPS in 3 of its trailing 4 quarters, with an average surprise of 3.27% over that longer-term period, though the most recent quarter's beat was notably larger than that longer-term average. Cash flow. Detailed standalone Q2 2026 operating and free cash flow figures, information not publicly available as a distinct reconciled line item in the sources reviewed for this report. Readers should consult the complete 10-Q for detailed cash flow statement figures. Balance sheet. As detailed in Section 10, total assets reached $98,253 million as of June 30, 2026, with long-term debt of $19,111 million and shareholders' equity of $31,977 million, reflecting the substantially larger post-Calpine balance sheet. Guidance. Management raised full-year 2026 adjusted operating EPS to $11.50 to $12.50, up 50 cents from a prior $11 to $12 range, with the new midpoint of $12 now sitting at what was previously the top end of guidance, reflecting continued accretion from the Calpine acquisition, higher PIM capacity prices, and ongoing commercial execution. Management commentary. CEO Joe Dominguez stated, "Strong results, an increase in guidance, positive regulatory developments, good progress on strategic transactions. Our team delivered." CFO Shane Smith added that results demonstrate the earnings power of our expanded platform, strong operational and commercial performance, and the disciplined execution of our capital allocation strategy, while emphasizing continued focus on integrating Calpine, capturing the value of our expanded fleet, and investing in opportunities that generate attractive returns. Management noted that a $115 million negative year-over-year swing in Illinois Zero Emission Credit (ZEC) revenue recognition timing, $85 million recognized in Q2 2026 versus $200 million in Q2 2025, partially offset otherwise stronger results, but characterized this as a timing item with no impact on full-year guidance. Key changes versus previous quarter. Full-year 2026 EPS guidance was raised for at least the second consecutive quarter, with the new midpoint matching the prior range's top end. The company signed an additional 920 megawatts of new long-term nuclear power purchase agreements during the quarter. The Crane Clean Energy Center restart cleared 2 significant regulatory milestones: NRC approval of a new fuel licensing amendment and an FERC waiver enabling capacity injection rights transfer from the retiring Edstone facility. Constellation filed subsequent license renewal applications for the Jinnah and 9 Mile Point 1 nuclear units in New York, extending its long-term fleet life extension strategy. Year-to-date share buybacks reached approximately $2.2 billion, with additional authorization remaining, continuing the company's capital return program even amid active Calpine integration. Section 12. Growth Drivers. Continued AI data center power purchase agreements. Following the Microsoft and Meta deals and the additional 920 megawatts signed in Q2 2026, continued new long-term PPAs with hyperscale technology companies represents Constellation's clearest and most direct growth lever. Crane Clean Energy Center restart completion. Successful completion of the 3 Mile Island Unit 1 restart on its second half 2027 timeline would validate both this specific project and the broader industry viability of restarting previously shuttered nuclear capacity. Full Calpine integration and synergy capture. Completing the required PJM and ERCOT divestitures and fully realizing commercial and cost synergies from the combined 60 gigawatts fleet, particularly in Texas and California, represents a substantial multi-year value creation opportunity. Nuclear fleet life extension. Recently filed subsequent license renewal applications for the Jinnah and 9 Mile Point 1 plants extend the operating life of existing, already depreciated nuclear assets, supporting long-term cash flow generation with minimal incremental capital. Continued capital return to shareholders. With $13.6 billion of deployable capital cited over the next 2 years, continued share buybacks, already $2.2 billion year-to-date, alongside the regular quarterly dividend, provide an additional avenue for shareholder value creation. Section 13. Key risks. 4. Calpine integration execution risk. Integrating a $21.8 billion acquisition that added $12.6 billion of assumed debt and substantially expanded Constellation's operational footprint carries meaningful execution risk. The company still must complete mandated divestitures, 5 PJM plants to LS Power, Brazos Valley Energy Center, by year-end 2026, and any delays or complications could affect the pace of synergy realization. 4. Stock underperformance amid deal-related technical pressure. CEG shares are down approximately 21% over the trailing year, despite strong underlying operating results, which independent analysis attributes partly to post-acquisition lockup expiries from the 50 million shares issued to Calpine sellers, and a handful of analyst downgrades, a dynamic that could persist as remaining lockup periods expire. A. Regulatory uncertainty on PJM large load interconnection rules. PJM's rules governing how large data center loads can interconnect with or co-locate at existing generation assets, like Constellation's nuclear plants, remain unresolved, with clarity not expected until the first half of 2027. Unfavorable rule outcomes could constrain how quickly the company can monetize its fleet for data center customers. A. Crane Clean Energy Center restart execution risk. The 3 Mile Island Unit 1 restart is an unprecedented undertaking with no direct U.S. precedent. Despite recent positive regulatory milestones, any technical, schedule, or cost issues between now and the targeted second half 2027 return could affect both this specific project's economics and broader market confidence in the restart concept. 4. Substantial debt load following Calpine. Long-term debt of $19.1 billion as of June 30, 2026, reflecting the assumed Calpine debt, increases Constellation's financial leverage in interest rate sensitivity relative to its pre-acquisition capital structure. A. Illinois ZEC revenue timing volatility. as demonstrated by the $115 million negative year-over-year in Q2 2026 Illinois zero-emission credit revenue recognition. Certain state-level clean energy support mechanisms can introduce quarter-to-quarter earnings volatility that requires careful interpretation. A. Merchant market price exposure. As an unregulated generator, a portion of Constellation's revenue remains exposed to wholesale electricity price fluctuations for capacity not yet locked into long-term contracts, unlike traditional rate-regulated utility peers with more predictable regulator-approved returns. 4. Political and regulatory sensitivity around federal support. Constellation received a $1 billion federal loan to support the Crane restart and separately saw the Edstone gas/oil plant ordered to remain operational by federal directive. Continued reliance or exposure to shifting federal energy policy priorities introduces an additional layer of regulatory uncertainty. Section 14. Valuation. Metric. Value. Forward 12-month PE. 21.28x. Industry average forward PE, 23.09x. CEG trades at a discount. Net profit margin, below industry peer average per Zacks pre-earnings analysis. FY 2026 adjusted operating EPS guidance, $11.50 to $12.50. Trailing one-year stock return, roughly minus 21%. Deployable capital next 2 years, $13.6 billion. Constellation currently trades at a modest discount to its industry peer group on a forward PE basis, 21.28x versus a 23.09x industry average, despite owning what is widely regarded as the single most strategically valuable generation asset base in the sector for capturing AI-driven power demand. This valuation gap, combined with the stock's roughly 21% trailing year decline, even as fundamental results have improved, suggests the market remains focused on near-term integration and execution risk from the Calpine deal and technical selling pressure from lockup expiries, rather than solely on long-term earnings power. Independent analysis has framed this as a potential disconnect between Constellation's improving fundamentals, raised guidance, new PPAs, on-track Crane restart, and its current share price, though investors should weigh this against the genuine execution risks discussed in Section 13 before drawing conclusions about relative value. Section 15. Upcoming catalysts. Catalyst. Expected timing. Why it matters. PJM Large Load Interconnection Rule filing. Approximately November 2026. Will shape how efficiently large AI data center loads can connect to or co-locate with Constellation's generation assets. PJM Co-location Rule Clarity. Q1 to Q2 2027. Final resolution of this regulatory question directly affects the economics of future data center power deals. Completion of IS Power/Brazos Valley divestitures by year-end 2026. Final step in satisfying DOJ antitrust requirements for the Calpine acquisition. Q3 2026 earnings report. Information not publicly available, typically early November. Will show continued Calpine integration progress and any additional new PPA announcements. Crane Clean Energy Center return to service, second half of 2027. The most closely watched individual milestone in Constellation's portfolio. Successful completion would validate the broader nuclear restart thesis. Ginna and 9 Mile Point 1 license renewal decisions. Ongoing regulatory process. Would extend the operating life of existing nuclear assets, supporting long-term fleet value. Section 16. Long-term outlook. Constellation's long-term outlook is closely tied to the durability of AI-driven electricity demand growth and the company's ability to continue converting its existing generation fleet into long-term, high-value contracts, much as it has already done with Microsoft and Meta. If this demand environment persists, as most independent industry analysis currently expects, given the scale of data center build-out underway across the U.S., Constellation's combination of nuclear scale, now expanded natural gas capacity via Calpine, and demonstrated ability to execute complex projects like the Crane restart and other nuclear fleet life extension initiatives. If these elements come together as management currently expects, Constellation's current valuation discount to peers could narrow meaningfully as the market gains confidence in the durability of the company's earnings growth trajectory following its transformation into a nearly 60-gigawatt combined generation platform.
Section 17. Bull Case. Bull Case Summary. Calpine integration proceeds smoothly with the remaining PJM and ERCOT divestitures closing on schedule by year-end 2026 and commercial synergies materializing as management expects. Constellation continues signing new long-term nuclear PAs with additional hyperscale customers beyond Microsoft and Meta. The Crane Clean Energy Center restart completes successfully and on schedule in the second half of 2027, validating the broader nuclear restart concept. PJM's large load interconnection rules resolve favorably for generators with existing co-locatable capacity, and the stock's current valuation discount to peers narrows as lockup-related technical selling pressure fades and the market fully credits the company's improved, larger-scale earnings power. In this scenario, Constellation could solidify its position as the preeminent power supplier to America's AI infrastructure build-out, supporting continued EPS growth and potential multiple re-rating from current levels. Section 18. Bear Case. Bear Case Summary. Calpine integration proves more complex or costly than anticipated, with the mandated divestitures facing delays or unfavorable terms. The Crane Clean Energy Center restart, being an unprecedented undertaking, encounters technical or schedule setbacks, pushing its return to service date beyond second half 2027. PJM's large load interconnection rules resolve unfavorably, constraining Constellation's ability to efficiently monetize its fleet for data center customers. Continued lockup expiries and analyst caution keep pressuring the stock despite improving fundamentals, and the substantial $19.1 billion debt load from the Calpine acquisition limits financial flexibility if interest rates rise or merchant power prices soften. In this scenario, CEG shares could continue underperforming despite genuinely strong underlying assets, as the market remains focused on integration and execution risk over long-term earnings potential. Section 19. Final Investment Conclusion. Constellation Energy has, since its 2022 spin-off from Exelon, transformed itself into what independent analysis widely characterizes as the primary power counterparty for America's alpha data center build-out, a position built on the nation's largest nuclear fleet, landmark 20-year contracts with Microsoft and Meta, and now a substantially expanded, nearly 60-gigawatt combined generation platform following the January 2026 Calpine acquisition. Q2 2026 results, with revenue up 23%, an 8% plus EPS beat, and a second consecutive quarterly guidance raise, demonstrate that this larger platform is translating directly into improved financial performance. At the same time, investors need to weigh this strong operating momentum against genuine near-term execution risk. Constellation must still complete mandated Calpine-related divestitures, successfully finish the unprecedented Crane Clean Energy Center nuclear restart, and navigate unresolved PJM regulatory questions that will shape how efficiently it can monetize its fleet for future data center customers, all while carrying a substantially larger debt load than before the acquisition. The stock's roughly 21% trailing year decline, even amid improving fundamentals, suggests the market has not yet fully resolved how to weigh this combination of genuine strategic strength against real integration and execution risk. Bottom line, Constellation Energy offers investors direct exposure to the most strategically important power generation asset base in the AI data center era, backed by demonstrated commercial execution and a track record of converting existing nuclear capacity into premium long-term contracts. But the path forward requires successfully digesting a transformational acquisition and completing an unprecedented nuclear restart, both of which carry real near-term execution risk. This report does not constitute a recommendation to buy, sell, or hold CEG shares. Readers should review the company's complete SEC filings and consult a qualified financial advisor before making any investment decision.